Hi everyone, hope you're all doing well, and today we're going to talk about the free stocks to buy April 2021 edition. This is the most popular video series that I do on the channel, where I talk about the free US stocks I'm looking to buy in the current month or the upcoming month. I'm a bit late, so it's the current month this time round. I will do my UK version in a few days time. I'm just trying to think of a third stock for that one. But yeah, we'll talk about the free stocks I'm looking to buy April 2021 edition. It was a tough one. There's a few stocks that are actually at interesting prices. So honourable mentions to DraftKings could have made this list, as well as Beyond Meats and also Callaway Golf. Those are three stocks that were very close to making this list. But I think the other three have sold off a lot recently and are probably at very attractive valuations right now. So yeah, it was a very close one, so I'll give them three a shout out, but these are the three that I've gone with this month. And yeah, I'll spend about 5 minutes on them. I think all three of these stocks, I might do a full 20-minute video on them at some point, but if you could, smash the like button. If you're new, subscribe. And if you do want to know when I'm buying and selling companies, make sure you join my Patreon. The link is in the description. On there you get to know when I'm buying and selling companies, exactly when I'm doing them. There's also a Discord. There's also 2 exclusive videos on there a week, so it's not a bad community we've got going on there right now. But we'll go through these 3 companies I'm looking to buy in the month of April 2021. So the first one is Teledoc. So this is a new company into the portfolio, the first new company I bought for a little while. So we're going to talk about this one first of all. It's a very in-depth company. There's a lot of stuff going on with it, so I won't be able to go through it all today. I think this is definitely one that might be a full video somewhere down the line. But yeah, I must have spent a good 7 days looking into this company. I read a lot of articles. I read through all their investor presentations. I went through their investor day video, which I think was 4.5 hours long. So yeah, I did spend a long time researching this company, and eventually I got to a point where I was like, okay, I'm actually very confident in this company. I'm going to go buy it. And I'll talk about some of the main positives and some of the main negatives of this one, because it is, as always, I like to be transparent. I give you the honesty of these are what I think, how it will work out, but these are also some things just be really careful of when you're buying this one. So this is my opinion on Teledoc. So I first started buying this one, I believe it was this week, at the start of this week. I bought my first set of shares at $180. My plan is if it goes down now to 150, I will double up, and then if it goes down to 120, I will double my position again, and that will build it out to a decent position, and it will probably be in my top 5 biggest positions. If it gets down there, is a different story. It might not get down there, but I feel like with the drop that it's currently on, which I'll talk about in a little bit, I thought I'll take advantage and see where it goes from here. So yeah, I did start buying some shares in Teledoc. So first of all, the main thing that got me interested in this is the TAM, the total addressable market. Healthcare, I don't really have a healthcare stock, which was also the thing of I'm diversifying the portfolio a little bit. Sure, it's a little bit tech side, but I don't have any healthcare stocks at the moment. And yeah, I think when I look at the TAM of this, I think healthcare hasn't really been advanced that much recently, and obviously Teledoc having the ability to, for doctors to talk to patients rather than going into the building, convenience wise, 24 hours a day. If you're poorly at 3 a.m, you don't have to worry about going to the doctors or the hospital at 3 a.m. All you need to do is get onto your account, whether that's a one-off payment or you have a membership with them guys, and you can use your membership to get an appointment. It's just very convenient, and it just is still the very same business model as what we've had for so many years. But I think, like I said there, the ability to go to have a membership, all you need to do is all on your phone, appointment, see you in an hour, don't have to leave the house. It's very convenient, and you can pretty much get nearly the same service. I think it's only 6% that need to then actually go on to an actual in-person appointment. So yeah, it just saves so much time really, and it's convenient as well. So I think the TAM for this is huge. It's one of the healthcare is one of the biggest industries in every economy. So yeah, I think that Teledoc, with the range of products they will be able to address, will be huge. Now, first of all, the sell-off. The sell-off was the first thing that interested me into this company. So this was one that really benefited from the CV. And then 2 months ago, as we know, we had the crazy tech rally where valuations went insane. And this was one that kind of just sold off absolutely huge because of the run it's been on. Still benefited, quite a bit, but the prices Teledoc are right now, I think they're back down at the prices it was at back at May time 2020. So pretty much all of the benefit of the CV has been taken out of this company. And sure, when you look at, we'll talk about the valuation a little bit, but the one thing is the valuation was a little crazy. It was 60 times sales or something. But you've got to remember, it has benefited from the CV situation. More and more people are using Teledoc than what they would have done previously, and that's brought a lot of new clients forward that they wouldn't have had if it wasn't for the CV, and it will continue to grow. So the CV has benefited the company in the long term. But when you look at the share price, it has sold off back to like nearly pre-CV levels, and so it's lost all the benefit it's had from the CV, and that was one of the big things that sure, you can justify it was a bit of a crazy valuation a few weeks ago, but has it sold off too much? And I think when you look at the company, it's at one point it nearly lost half its share value, which I was like, that's absolutely crazy. Now, the one thing that really stands me out is the telehealth service is going to be a sector that grows absolutely huge over the next few years. And the one thing that Teledoc has is it's the first mover advantage. So it has the benefit of being the first company in this kind of sector at the moment. The first company to be in the sector. There's a few more appearing. But the great thing it has now is a range of cares. So it covers a lot of different areas. I think one of the big things could be the mental health it covers. I think that'll be one that I think on the recent earnings report, it said that 40% of clients that use a mental health service on Teledoc wouldn't have used or gone to get some help for the mental health. It's just they find it more easy for them to go and do a phone appointment or on a webcam appointment, which I thought was absolutely huge. It bought Livongo. You can say that they paid up for that one at like 31 times sales or something, but that's now the next step for them, and they cover so much more health services. And another thing why the reason dropped is that these guys as well, they sandbagged their this 2021 quarter. So basically what they said is like pretty much we're not going to grow that much on paid memberships through 2021, and everyone was like, whoa, what's happening? The growth's absolutely not growing at all really. But realistically, this is what management do all the time. They're unsure like how much growth has been pulled forward because of the CV situation. So the numbers that Teledoc have set out now are so easy for them to beat in the next few months as well. I noticed that one from the earnings call, which was pretty good. So yeah, I think when you look at that, also when you think about, obviously in the UK we're lucky because we've got the NHS, so we don't have to pay for services. But every other country you would have to pay for insurance, or if you're to get some healthcare, you have to pay. So paying for Teledoc just makes sense. And for insurance, and if you're obviously some companies might pay for their companies like health insurances as well, is if you were a company that wanted a health service, well, you got to Teledoc because it's convenient, the fees are pretty good, and you've got such a range of services under one name. So I think it makes more appeal for companies, insurances to start using Teledoc as well. So yeah, I think when you look at how far they developed in front of everyone, the total addressable market is going to be huge. And yeah, I think when you look at the growth side of it, I think it could be a little bit unprofitable, but as it ramps up. But you look at the revenue growth, it's going to be 100% revenue growth this year as well because of the Livongo merger. So yeah, that's absolutely great. And there's two negatives. So the valuation will be one thing that does put people off. This is one thing that I was trying to get my head around. Now, if they did hit their 2021 numbers, obviously they've got the Livongo in there now, it trades at a price sales ratio of about 15, which is still, it's still high, but it's not crazy for a company growing at 100% rate that is in a massive, one of the biggest TAMs, that also is growing at 100% rate, 100% revenue rate. I was like, you're going to have to pay up for this. There's no way you're going to get this company at like a price sales ratio of 4 or 5, you're going to pay up for it. And I thought, when you start running the numbers, if they hit their numbers, it actually isn't that bad of a valuation. One of the biggest markets, massive growth, first mover advantage. I thought, yeah, the valuation is a little high right now because you're looking at it, it's like 30 price sales ratio. But if we start running the 2021 numbers with the Livongo merger in it, it's actually not too bad. So the valuation might put a few people off, but what I'd say to that is that you're getting the first mover advantage, one of the biggest TAMs out there as well, 100% revenue growth rate. If we compared this to one that I covered the other day, which was, I said the valuation was a lot higher, or high was like Palantir. Now Palantir trades at a price sales ratio of like 40, grows at 40% rate compared to 100% rate. And you look at Palantir, mostly going to be used by the big massive companies out there. Teledoc, everyone needs healthcare services, and that's the little difference why I can be a bit more okay with this valuation than say something like a Palantir, for example. And the other negatives is Amazon. So this will always get, whenever some news comes out about Amazon Health, it could be what knocks the share price a little bit down, 6-7%, because people are worried that Amazon Health might come into this. Now, Amazon Health is currently only available to the people that work for Amazon, but in my opinion, for Amazon to get to the level that Teledoc are, they're still very much years behind. And even if they did expand to the healthcare service, not just the people that work for Amazon, but the average Joe, the problem is as well is like the range of services they have would never be able to get to Teledoc standard for quite a few years. And then you would hope by then Teledoc already have so much amount of the total addressable market as well. So I think that's something to be careful of. But like I said, I still think Amazon would be years behind, and Teledoc would hopefully use his first mover advantage even more than what they're doing right now, and it would just be such a hard catch up for Amazon. So yeah, overall, buying some shares in Teledoc, bought 180, and like I say, that's where I'd average in if I can get there. Like I say, valuation a little high, that's why I'm going and averaging in from here. If it doesn't get down that low, hey, I've still got some shares in there, and I'll probably make a nice bit of profit on it. But number one is Teledoc. So number two is Skills. So I think this one was actually due a video at some point, but hopefully put in here covers it slightly, but I might do a separate video on this one. But Skills, oh my goodness, like the share price on this one has been absolutely killed. I think the stock's nearly lost half its value, and don't get me wrong, when Skills was trading at $40, crazy valuation, it had gone up way too much. So it was due a bit of a pullback, but there's no way I thought it'd go from like $40 down to like $17. Absolutely insane pullback. The two things that affected it is that it had a short report, which was our good friends at Wolfpack that are very good at making a lot of false claims up, which they did in that short report as well. They timed that perfectly at a crazy valuation, very much like EHang. And then we kind of got the like whole tech correction, and then it pulled back even more. And I never thought the days of Skills, being at $17 would come back, but here it is, it's back at $17. And the funny thing about Skills is that the amount of people that when this was like going up and up and up, I started buying this company at $14, and I think my average right now is like $18, I think. So I have averaged up it a little bit slightly. Is that when this stock started going to like $22, I had people messaging me like, oh, have I missed, is it too late to buy Skills? And then it got to 25, and same again, I got people messaging me. 30 people messaging me again saying, is it too late to buy Skills? And then all of a sudden we have a big massive pullback, and then what you start seeing is people going, oh, I don't know if I want to buy Skills now because it's sold off. And it's like, oh, I don't know if I like Skills now. And it's like, well, there's something going on here. Either you were getting FOMO'd when it was going up and up that you missed out, or now that you're too scared to buy in, now you've got good prices. And this is the thing, like when stocks go up and up and up, that's the time when you move away from them and you be cautious and maybe you take some profit. When stocks go down, these are the times where you should be like, oh, this is where I need to pick up. These are the best times to make money. And it was just funny seeing like the FOMO that was going on, and now that Skills is at about what I think the valuation is actually pretty good, and you've got like nerves about maybe buying it or not buying it. And if you start running like 2022's like revenue on the price to sales ratio, like the valuation on Skills is very good for the growth you're paying up for in this company. I think is amazing. So if you don't know what Skills does, it basically is a mobile gaming company. Now mobile gaming is growing absolutely huge, and the TAM for this one is huge as well on this company. But the difference is that this is the first public esports gaming company on here. So what you can do is you can play the normal games, or you can even do wagers or go into tournaments. And when you think about how much that can scale up, it could be huge. We know what esports is doing already. And then you also think about the more and more games they develop. At the moment, Skills, I think the one big thing that people make the mistake of with Skills is that they forget it's such an early stage company. Like at the moment, they only have a few games, and a few of these games are just little easy like Tetris-like games. Like the bubble popping one where you've got the gun and you got to match like 3 of the same colours up. I'm currently playing it on the Skills game shooter, which I think my high score is like 120,000, so you can see if you can beat that. But I've been playing on the Skills game myself. I think they're absolutely amazing. One of the biggest negatives I really see about Skills is like that people say the games aren't very good. But from my experience, I play the games. I think the games are very good. And I don't know if the people say the games are not very good just because they're so basic. But the thing about having really basic games is that it's just so easy to pick up, and you have a mass audience then. You don't need something like a big instruction guide of how this game works. Like a League of Legends or something like that, where it takes days of learning. Whereas Skills, you literally pick it up and you're like, these games are so easy to pick up, and then you get more and more people playing them. That's why the Skills games apply to such different ages as well. And that's a big thing. I think Skills, the games are amazing. And like I say, at the moment I'm hooked on the shooter game they have, and I just keep playing that one all the time myself. So I have no problems with the games. Now, if they do want to do more and more complicated games, if they do want to do, shooter games, more and more complicated racing games, that can happen, and they'll give them more and more income there. We know about the partnership with NFL. If there's more and more partnerships that happen, and at the moment, Skills haven't even got like a top 10 app yet. If they get a top 10 app, that is a game changer, and it's going to just, go crazy. But when we look at Skills, it's still early stages company. It's only a few years old, and the games they have had have been very successful, and that's clear in the company's revenue performance. When we look at Skills' performance, I tell you what, the company's growing at 100% revenue. A bad company does not grow at 100% revenue growth, and that sums it up. If the games were bad, if it was a bad company, tell me why for the last few years this company's been growing at 100% revenue growth. And as they develop more and more games, as they get more and more partnerships, as they get more and more developers and they have more games out there, it's an early day company, but what they have at the moment is unique with that esports, the tournament side of it. You develop now where you can watch people playing in tournaments as well. So you've got a streaming company in here as well, and the esports is going to be huge. Streaming is going to be huge. Mobile games going to be huge. I generally think that this is, people are forgetting how early days this company is, and when I look at this company, I generally think it could be a massive company down the line, and I think it's a great one. So yeah, and the only really one negative I do have of this company is that there's going to be, because of the business model, the cash rewards and getting customers, the only thing that's going to be really here is the profit side of it. It's going to be hard for them to ramp up profit. It's going to be they're going to burn through a lot of cash, and that's the only thing to be really careful of. But apart from that, when you look at the TAM, the growth that they've had previously, and it's really early stages, the more they ramp it up, I'm sure, you ask anyone, many people don't know who the Skills actually are yet, and the more they ramp up, it's going to be huge. So I think when Skills is down at $17, I'll just have more and more, because if you told me like 2 months ago I'd be able to buy Skills at $17 again, I wouldn't have believed you, but we've got it, and it's one that I'm buying quite a lot of at the moment. And number 3 is Huya. So this is one of my newish really Chinese plays that I do have. It's one that I started buying a few months ago, and I do expect in the next 12 months this really to kick on in value. In fact, it did. Last time it was at this value, the stock went up to $32, and then it's been pulling back recently, and when Huya is about in the $18 range, I think it's a really good buy. So I'll go through this one, but it's one of the ones that's been on the channel for a while. I think this is the one thing, the merger. The thing is, when I do free stocks to buy, I start covering this one up. But this is the thing that's holding it back, and once this is done, hopefully in the next few months, this, in my opinion, will kick on to $40 and above. So Huya, basically it is a streaming platform, and it's mostly a gaming streaming platform, and also it's helped with the growth of esports. So you got Huya, which is the number one streaming platform in China. You've got esports that will grow huge, you've got streaming that will grow huge, the gaming that will grow huge, and then you've just got a massive growth company here with that. So it's like the Twitch of China basically. So that's the key catalyst for it going up. First of all, the valuation is just crazy cheap. And when we look at the growth side of it, this company is growing at 30% revenue rate. The profit is even growing huge on that one. And the valuation is just sitting at like a forward P of like 17 or 18 right now. The more this sits or goes down, I mean, it might have gone down even more now, but the valuation is just crazy cheap. To be picking up a 30% revenue growth company at that forward P is just absolutely crazy. And then when you got the growth side of it, like it just grows and grows because it's in a growing area and sector, and that will just help it. And the more it grows, like the company has pretty much stayed the same for a few years now. And the more it grows, the valuation just drops and drops. And I think maybe the reason why it's not going up in value as much is because the company, like, I think it reported 30% revenue growth, but earnings were taken bad because it missed out on earnings, because it for some reason, like, it missed like by 1 million on the expectations, but it still grew at 30% revenue growth. And it's like, is it really bad earnings if a company carries on growing at 30% revenue growth just because it missed slightly? And I think that's maybe one reason. I think the main reason is the merger. But the thing is as I'm holding this company for the next 6 months, the valuation is just dropping as it's growing and growing. And it's just the point of view, like, if someone came to you and offered you a year ago to buy a stake in their company, and they basically said, look, you could buy a stake in my company for 1 million, 50% for 1 million. If you said no and you saw the same guy like a year later and he said, oh, since then our company's grown 30% in revenue, do you think they're going to offer you 50% stake at 1 million again, or do you think that you'll have to pay up more? And like profit's grown 100%. So if you got the same offer, you wouldn't, would you? Because the company's now at an even better standard. And that's the same for Huya. The more the valuation goes the other way and the revenue and profit goes the other way, it's just insane. And I think like it won't be long until this, in my opinion, this stock's a $40 company. Now, I think the one thing that has held it back is the merger. So these guys are supposed to be merging with Douyu. I hope the merger does happen. If it doesn't, I still think Huya will be a great company. But what will happen is then they don't have to compete to have streamers on their platform, and as well as that, they'll have 80% of the market share as well in the esports streaming side, which would be huge. And so that would just help them absolutely huge. You have Tencent there as well. Tencent that has the games that these guys are streaming, all ties up very well. I think the merger should be done in the next 2 months. The merger gets done, then investors don't like uncertainty. The uncertainty goes away, investors come in, and the share price goes up and up and up. And like I say, in my opinion, this stock already should be a $40 stock. That's a given. My opinion is where it goes on from there, and I think this company could be $60, $80 stock in the next few years. It reminds me a lot of Bilibili back when that was in 2018. So yeah, while Huya's at $18, it's one that I like to buy as well. But yeah, these are the 3 stocks to buy. April 2021 edition. I hope you enjoyed the video anyway. Let me know what you're buying. Let me know if you're buying any of these 3, and maybe if there's demand, I can maybe do a full 20-minute video on them anyway. This one's already long enough, but if you want any more information, maybe that can happen. But yeah, smash the like button if you're new, subscribe, and I'll see you in the next video.